Millions of American homeowners are paying tens of thousands of dollars literally in private mortgage insurance. So I'm hoping that you and the millions of people that are watching this video and listening to this recording will learn how to stop that, how to stop paying unnecessary payments, because the mortgage company is not going to call you and tell you you can now stop paying it. You've got to take a little bit proactive approach for yourself, and we're about to get into that right now. Hey folks, thank you for tuning in. Thank you for watching. My name is Wayne Turner. I'm a residential real estate broker right here in the Metro New Orleans area. Now, most people watching, listening are going to be paying $200 to $300 per month on their mortgage payment to pay this PMI. Many of you are paying even more than that. So when you look and add that up times maybe 3 years, 4 years, 6 years, 8 years, look on your statement and see, you're like, holy cow, I've been paying this for 7 years, 8 years, 10 years, and I have enough equity in my property. I've been paying tens of thousands of dollars of unnecessary payments that I can now stop paying. I mean, this money that you've been paying can now be used as college tuition, retirement savings, the boat you've been wanting, the pool in the backyard, or whatever it may be. A lot of people are paying $200 to $300 to $400 a month in this private mortgage insurance. Now, many of you are aware that private mortgage insurance is an insurance policy that the mortgage company puts in place whenever you get a loan on a property, and they do so when you do not put 20% down. So if you go to purchase a house, you do not put 20% down, they're going to require you to have private mortgage insurance in which you pay the monthly premium. It's an insurance policy that the mortgage company, they've taken out. It's covering your mortgage in case you default on the loan, but you're paying the monthly premium. You're paying the monthly premium every single month. And look, most people do not put down 20% when they purchase a home. Let me explain. So if you purchase a $400,000 home, in order to put 20% down on a $400,000 home, you're going to have to put down $80,000. $80,000 is a lot of money, especially in the perspective of a $400,000 home, and the average housing market around the United States is a move-up home. That's not a first home, that's a second or a third home. So typically there's not enough equity to be rolled from one house to the other to accumulate or make up that $80,000, that 20%. You can, however, get a loan with just 5%, conventional loan for $400,000, and you put down 5% as opposed to the 20%. The difference is $20,000 is 20% of $400,000, and 20% is $80,000. The difference is $60,000. So if you put money down on the house at just 5% and you can keep the $60,000 in your bank account, cash is king, right?
Oh, you're right. And when you're right, you're right. And you're always right. So
let's look at the scenario. Monthly mortgage insurance on a $360,000 loan, if you put down 20%, it's going to run you about $300 a month. And if you look at the difference between the $20,000 that you would put down and the $80,000 that you could put down, there's $60,000. The magic question is, how long will it take you to recover your money? So if you have $60,000 that you either have in the bank or you put down on your home, how long will it take you? So if you paid $300 a month into this $60,000, it will take you 16 and a half years to recover your money.
What?
Now, keep in mind, I know that by putting down 20% as opposed to 5%, and the difference between a 5% down payment on a $400,000 home and a 20% down payment on a $400,000 home, the difference in that mortgage payment is $213. But still, it's going to take you 16 and a half months to recover that money. And this is why most people do not put the 20% down. They'd rather pay the PMI. And there's another reason. Stay with me. And that reason is PMI can be removed. Private mortgage insurance can be taken off of your mortgage. After, it could be 2 years, it could be 5 years, it could be 7 years. Basically, every single home is going to be different in every single housing market. And the reason being is that what improvements have you made to the home and how has the housing market improved? So once you have 20% equity in a home, you can attest to your mortgage company and say, hey, I have 20% equity in my home. I want to have the PMI removed. Now, that has a lot to do with what improvements that you've made to the property and what is the market. So you have to figure out what is your market value of your home in today's dollars and what is your mortgage balance that if you were to pay it off today. And you've got to come up with that 20%. And I'm going to show you exactly how to do that. So you have to break out your paperwork. That's what you have to do. I know it's boring. I know it's tedious. None of us have read any of that stuff because, let's face it, it takes 25 pages to basically tell them if you don't pay, you don't stay, right? But in this case, you want to break out the paperwork. And if you can't find it, then reach out to your mortgage company, call them on the phone, speak with somebody and say, hey, could you email me or send me in writing or show me where I can find where it says that once I have a certain amount of equity in my home. Look, some mortgage companies it's 20%, some it's 22.5%, some it's 25% if you haven't lived in the property at least 5 years and made significant improvements to the property. That's why I say you can have this PMI removed in a couple of ways, but you have to read the fine print and make sure that you're doing it within the scope of the rules, regulations, or whatever they've set forth with your independent mortgage company. So what's the big deal with private mortgage insurance? Why do you have to have it anyway? It's really simple. It's an insurance policy that they place on your property, your mortgage company places on your property. So private mortgage insurance is an insurance policy the mortgage company places on your property, and you agree to pay that so long as you not put 20% down. If you put 20% or more down on the property, then they don't require you to have a private mortgage insurance policy. Now there's different loans, and you need to find out which type of loan yours is. Is your loan a conventional loan? Or is it an FHA loan? Like if you did an RD loan, Rural Development, USDA, those are FHA loans. If you did a conventional loan, then it's pretty simple. You can contest it once you have basically 20% equity. FHA, if you have an FHA loan on your home, if you purchased that home after 2013 and you did not put at least 10% down, if you didn't put 10% or more down on the property, that PMI will never be removed. It stays on there now. The only way to get it removed is to physically refinance your property under a conventional loan or some other type of loan, basically to get out from under the FHA clause that says you have to pay it forever if you purchased the home and got that FHA loan after 2013. Now VA guarantees loans. The Veteran Administration guarantees loans for veterans. So there is no PMI on VA loans. The Veterans Administration, the U.S. government says we guarantee the loans. They've served our country, which is great, and they don't have to worry about paying this. So if you're a veteran, you're watching this, or you know someone who's a veteran, they got a VA loan, they don't have to worry about this. It's not even on the mortgage payment. So how do we get PMI removed? How are we going to get that taken off our mortgage payment? Go with me here. One option, as I mentioned, is to refinance the property. But keep in mind, when you refinance the property, you want to make sure that you have 20% equity in the property. In other words, what is your balance on the property and what is that balance going to be? And what do you physically, what's it worth? What is the property? What do you owe on the property and what is it worth? Now, keep in mind, a lot of people will say, well, it won't cost you any money out of pocket to refinance. There's a difference. Will it cost you any money? Because most banks, most lenders, they'll have to charge you a fee because it's part of their policy. It's what makes the world go round, right? We all got to make money. So they will charge you a fee. Now, let's just say you're refinancing a $300,000 loan. Now your new balance may be $310 because they allowed you to roll all your closing costs. So you got to keep that into place and make sure that what your home is going to be worth and what its balance is, what you owe on it, there's 20% equity there. So after you know what the lender is required of you to have the PMI removed, it's now you have to figure out what is 20%, what is the value, what is the current value of my home, what is the value of my home in today's dollars. And so here's a couple of tricks, a couple of tips. Grab a pen and a piece of paper. You'll want to write this stuff down because this is exactly what you do verbatim to get the value of your home. Okay, it's really simple. You can have the home appraised, but why spend the $400 if you don't have to? Because you're going to have to spend that anyway, so don't do that just yet. Go with me here. Go to Google and Google top local best real estate agent. Find some of the top, not the pay-per-click ads. Don't look at the ads where it says ad. Look where somebody's like, they've done their homework and they're indexed on Google, and you can click on them. Make a phone call to them and tell them, hey, I'm looking to refinance my property. Could I offer you $25 or $50 to give me a valuation of my home and tell me what it's worth? Because I want to get the PMI. I watch this crazy dude sells a lot of real estate in New Orleans, and I want to get the PMI taken off my mortgage. Can you help me? Or better yet, if you're in a city or a state and you're watching this video, shoot me a message. Let us know where you're at. We can get you with a top agent in that area so you know you have somebody that you can trust and that you're comfortable with. But it's really simple. Find that agent, offer them money, $25, $50 to get the a market analysis on your property. Most of them will do it for free. I know here at Turner Real Estate Group, anyone in the entire Metro New Orleans area, if they needed that done, we can do it in a snap. It's no problem. We don't charge anything. It's just a service that we provide. And most real estate agents out there are not going to charge you it either. So now you've contacted the lender. You know for sure how to get it taken off. You know how much you got to have 20, 22, 25%. How much improvements have you done on the property? Because some of them will allow you, if you haven't made large improvements such as new floors, remodeled kitchens, baths, that sort of thing, new roof on the property, new windows, they want to make sure that it's seasoned enough, if you will. And like I said, it depends on all different lenders, so check with your lender. But once you know you have 20, 22, 25% equity in the property, then you can reach out to your lender and say, hey, I actually have a piece of paper that a real estate agent gave me, and this is what my home is worth. So what do we need to do with the next step? And they'll instruct you and explain to you at your mortgage company that you will have to have it appraised, and they will have to have it appraised. Now, all mortgage companies are different, but most of them want you to pay them the $400 to have the property appraised. They will order the appraisal. And the reason why they do this is because they want to make sure that it's not just somebody's uncle, cousin, brother that appraised the property. They want to know, because you got to keep in mind, they're processing all this paperwork, and they may be 5 states from you in Omaha, Nebraska, and you're in Florida. So they want to look and make sure. So they'll take your $400. They will order an appraisal. They'll send out a local appraiser. You'll be contacted by the appraiser. He'll set up a day, or she'll set up a day and time to come out and appraise your property. But listen, please, listen. This is another reason why I said grab a pen and a piece of paper, because this here is so important. This is what you have to do when the appraiser comes to your house. Number one, you want to clean it. You want to clean your house like you've never cleaned it before. Clean it like somebody's coming to buy it for way more than you've ever thought possible. Now, once you've cleaned, decluttered, it all looks really good, you'll want to do this. You'll want to sit down with a pen and a piece of paper, just like you have right now, hoping you're taking notes. And you'll want to take that pen and a piece of paper, and you'll want to walk through your house, and you have to write down every single improvement that you have made to that property since you bought it. Now, when the appraiser arrives at your property, you're going to want to do this. You'll want to hand them the list that you've typed out, print it out on a piece of paper. Try not to even write it in handwriting, so you want to make sure there's no discrepancy. You go and print it out, typed out, 16-point font, nice and big, list, hand it to them, ask for their business card and their email address. You'll want to email that to them as well as handing them the list. Now, what the appraiser is going to do, you're going to be surprised. They're going to be really receptive. They're going to say, thank you very much, I appreciate this. And you're simply just going to say this: thank you for coming out today. Here's a list of the improvements that we've made to the property. We're not pulling any money out of the property. We're just trying to get our mortgage insurance premium off, our private mortgage insurance taken off. Now, keep in mind, when they appraise a property, they do this. They can't typically go back more than 6 months. They never go back more than 6 months, and they're trying to look at homes that are as comparable to yours as possible. So in other words, if you're in a neighborhood, they want to stay within that neighborhood or subdivision, if you will. They're comparing bedrooms, baths, and most importantly, square footage. So once the appraiser has been out to your property, it takes 7 to 10 days for the appraiser to complete the appraisal on your property. You're paying the mortgage company to send out the appraiser. The appraiser was hired by the mortgage company. The appraiser cannot give you the appraisal because you didn't hire them to appraise it. You paid the mortgage company, and the mortgage company hired them. So they won't give you a copy, not the appraiser, but the mortgage company. Your mortgage company, that's your appraisal report on your property. They will gladly email you a copy of that. And you want to keep that for your safekeeping in your files, because it shows the value, shows the square footage, and anytime you're going to sell the property or anything like that, you want that information. Now, once this has all been done and verified, they'll send you out a letter. They'll inform you that it has been done and it will be taken off. And once it's taken off, you'll receive notification that your payment has been reduced. And so your payment will be reduced by the amount that you've been paying. So you no longer have to pay that. You have the equity in your property. So listen, I hope this video, I know it's a lot, it's a lot of information. If you have any questions, you can comment below. Send us an email, wayne@wayneturner.com. Anything we can do to help, let us know. If you like this video, give us a thumbs up, share it with somebody that you think would be beneficial in saving them money, and subscribe to our channel, because we have a lot of ideas and a lot of really cool stuff, hundreds of videos to come in the very near future. Hope you're having a good day. Thank you again for watching and listening. We'll see you.